Hi, everyone. I'm here with Philip Petursson, who is our Chief Investment Strategist. And Philip, I got to thank you again for taking the time. I know this is another very busy time for you. It's actually busy all the time. But thank you again for joining us. Appreciate it.
Not my pleasure, Rod. Very happy to be here. And there's a lot going on in the world right now. So I think it's great timing to talk about what's been happening.
Yeah, what I want to do is I really want to get into it. But firstly, I want to congratulate you because you just finished recording your 200th episode of your podcast, The Living Market. And I was going to say it's award winning. I don't know if that's the case, but I know it is one of the fastest growing listened podcasts in Canada in the financial and marketplace, correct?
Well, thank you for that. I mean, we're growing. We're growing. I don't know if it's the fastest growing, but every new listener adds one more. And yes, 200 episodes. We've been doing it for 4 years now, I guess. That's what it would take us to, and it's something that we're very very happy to do. We get really positive feedback on it, and it's just a nice, easy way to communicate our thinking to our clients across the country.
Yeah, I think it's tremendous. I do. I listen to it, usually when I'm going through the car wash or something. I'm teasing. I'm teasing. Let's get right into it though, because I was looking at the calendar and I thought April 6th, and I thought, wow, what happened last year in April? And I think you like to call it the Trump tantrum or the Trump tariff tantrum. We could call it that. What they called Liberation Day, what I called Destruction Day. But nonetheless, it was almost exactly a year ago that there was tremendous amount of volatility in the marketplace because of these announcements that he had made. And the end of the year ended up being incredibly strong across the board. And I thought I was really tying it into sort of the things that we're seeing today, which again has been a period of volatility, but I don't think it's been as extreme, has it?
Hasn't been at all. I mean, when we go back a year ago, you're absolutely right. We had that tariff tantrum, Liberation Day, the tariffs that have now been struck down or deemed illegal by the U.S. Supreme Court, which is a bit of a relief for everyone around the world. Yeah, we did see the U.S. equity market, for example, down intraday 22% from the intraday top to the intraday bottom. This is very, very different. Technically, we haven't even seen a correction yet. A correction being more than a 10% drop on the S&P 500, and that hasn't been the case. So, despite all of the headlines and perhaps the greater uncertainty around the war in Iran, the markets have been much better behaved than we were a year ago. Now, if you want to get into it, I attribute it or the key reason is because economically the world is in a better place. We are in a stronger environment despite the war today than we were a year ago. Manufacturing is increasing. Interest rates are still low. And in fact, since a year ago, we've had a couple interest rate cuts. Those are working their way through the system. We have the retail sales that are increasing. So, as far as the economic data that we look at, you compare it year over year, everything's better today than where we were a year ago.
Yeah, which is, I think, a real surprise for most people because they think about, the headline risk that's been occurring, which is almost daily, to be fair. And so, when you have these headlines that are coming up all the time, we all forget. But a little bit over a year ago, remember the economies of the world, and particularly the Western world, were coming through a period of rapidly increasing interest rates, which had really slowed the economy down. And then it was a matter of time before it could really start to find its footing again, which is where we're at today. And but there are some concerns out there, and the number one, I think, on everybody's mind, besides the fact that there's an active war again, and there might even be a bit of precedence to this from 4 years ago when there has been an invasion that's still going on, but it's about the price of oil. Price of oil affects everybody across the board. It affects you, it affects me. The concern's always about inflation, et cetera. I'm going to let you just run with that if you could.
Yeah, and that's the thing. Like wars don't rattle us. I mean, from an investment perspective, this is something that happens almost nonstop. There's always going to be a conflict somewhere around the world, and it can shake our confidence. We talked 4 years ago between Russia and Ukraine. You can talk, I think, 3 years ago between Israel and Hamas, and that set off the bombing in Gaza and back and forth, and to where we are today with Iran. So that's something that you can almost say will be a constant going forward. The difference between this one, though, and prior military conflicts is that it does impact the price of price of oil. And that's because of the Strait of Hormuz, right? This is that 21-mile stretch of water between Oman and Iran that largely is controlled by Iran. And they're choking off oil exports. Now, 20% of global oil flows through the Strait of Hormuz. And so when you start to choke that off, you get what we get, which is the higher price of oil. And oil prices aren't limited to just the Gulf or just Europe. They're global. It's a global commodity that can move anywhere. And so we're seeing it here. You're seeing it in BC. We're seeing it in the United States. Oil prices result in higher gasoline prices, higher jet fuel prices, higher food prices because of the transportation cost to ship food from one place to another place. And so this is where we pay a little bit more attention because there is a limit to how much the consumer and the global economy can bear in terms of higher oil prices. Now, I think more importantly, are we close to that limit? The answer is no. We're pretty far off. And we like to compare things in relative terms. So we talk about, here in Ontario, we're paying a buck 85 a liter. I was in BC a few weeks ago, and I think it was 214, 215, might be a little bit higher now. And that seems high. But let's go back to 2008, the last time, or rather the first time that oil prices crossed over $100 a barrel, right? So we had the kind of the same dynamic then, higher oil prices. There contributed a little bit to the recession that we saw in 2008 and 2009. But is $100 today the same as $100, say, almost 20 years ago? The answer is no. When we adjust it for inflation, take $100 in 2008 to where we are today, what is that price? It's $45, right? So adjusted for inflation, $100 today is like 45, almost 20 years ago. When we adjusted for the gains on the S&P 500, right? So we've seen massive gains in stocks since 2008. It's $22. We've seen strong gains in gold. Well, it's $18. So, are we at the danger zone for oil prices? No. We would have to get well above $150 a barrel. I even think closer to 200 before it was a significant headwind to the global economy.
And that's great insight, Philip. I love that you're able to put some parameters to it that people can really relate to. Is that without oil being at 150 to 200, there's really not a massive impact on things like manufacturing and inflation. That's what you're saying.
Exactly. Yeah, that's exactly it. I mean, no one likes to pay higher prices for things, but it's very affordable at this point in time. It's not as much of a shock to our wallets in terms of when we fill up our gas tank as it would be if we were at, again, north of 150, approaching $200 a barrel for oil. Then that would be now a meaningful decision saying, hey, you know what? Okay, do we go out for dinner or do I fill the gas tank? Well, I guess we're not going out for dinner tonight. We're going to fill the gas tank. That's the level in which we're talking about, but we're still well off from those levels today.
Yeah. Yeah. It's interesting. A lot of, again, for what the headlines are telling us, and again, these are awful events without question, and they all create stresses. And I agree, is that there's always a stressor in the world, and there's always a stressor in the marketplace. It would be abnormal that there's not. And it's a matter of steering through and having discretionary portfolios like you run. And just as a reminder, I mean, what you're able to do is within a pre-described framework is move these portfolios to be more preemptive and proactive. And that actually brings me around to the discussion of gold. And the reason I'm bringing up gold is because I've been hearing for a while now, I'm going to say particularly the last 3 months, clients are talking a lot about gold. Do we have gold? Do we have gold? And usually when I'm hearing it at that level, where this many people are constantly talking to me about gold, that is usually a market indication, it's contrarian, that it's usually at a top. Tell me about what you think about
Yeah.
gold.
Well, we would agree. We own gold in our portfolios or can own gold two ways. We can own physical gold, and we do this through an ETF, or we can own the gold miners, which are gold producers. And they're almost like big gold vaults because of the gold that they know is in the ground and they dig out of the ground and refine. But yeah, you're very right. When people are asking in volumes of people about an asset class, it's usually because it's made the news and it's near a top. Well, that's our view on gold. We've been bullish on gold for a couple of years, but now, we exited out of our physical gold position in our portfolios. We still own the miners because they're going to be profitable at the current price, but we don't see as much upside to gold itself from here. In fact, when we look at upside versus downside, we could see a little bit more downside. Now, this is all based on our fair value for gold. You can see forecasts out there for 6,000, 10,000, 20,000 for gold, but mathematically that wouldn't make sense. We measure gold against money supply, which is another measure of inflation or monetary inflation. Think of it that way. And when we look at it that way, then gold has exceeded the top end of the fair value range for us at the current price. And so at that point, we think it's a good time to take our profits, exit out of this, and then we can come back and revisit at a later time. But we right now we think there's much less upside for gold, and it can present some potential downside risk. And in fact, look at what's gone on during this Iranian turmoil right now. Gold is actually down from its high of 5,500 earlier in the year. It's still up on the year.
But opposite of conventional thinking, right?
Right. And when what is historically a safe haven asset no longer performs as a safe haven asset, says maybe the price has reached its peak.
Yeah, well said. So just to back it up, as I know, you within the portfolios, and I know this, you started to participate heavily in gold a few years ago and nibbling away. And of course, as gold has had a tremendous upside, that now you've completely exited from gold itself.
We have, yes. We added it into the portfolio in 2024. And our clients have done very well by it, given the gains in the price of gold since then. But at this point, we just felt that it was prudent to take our profits and wait for a better day.
Well, let's go to some easy questions. Okay, what do you think the dollar is going to do?
Well, this is really interesting. So the Canadian, we actually have a slightly downward bias for the Canadian dollar. Now it does change, right? So we follow this very, very closely. We have a model that we can update every single day on the Canadian dollar. And so here's the dynamic. The Canadian dollar has been more a factor of the difference in interest rates between Canada and the United States. Currently, US interest rates are higher than Canada. And we actually think that the risk is that the Bank of Canada could cut once more, just to provide a little bit relief to Canadian consumers. Our economy isn't growing quite as strongly as the United States economy. Our inflation is lower than US inflation. And if oil prices stay at the level where they are, while it's inflationary, the Bank of Canada might look at that and say, we need to provide a little bit more relief to the Canadian consumer to offset the gains in the price of gold. If you raise rates, it's not going to, or sorry, not gold, oil, the price of oil. If you raise interest rates, it's not going to change the price of oil, but it will provide a little bit of relief for consumers of oil in other areas. So, long way of saying, we think that the Canadian dollar could see a little downward pressure to 71 cents. That's our low end target right now.
Yeah, good. Great information. We get asked that all the time. No question. So, before I let you go, Philip, and do you want to just give me a general overview, or I give our clients a general overview, because you run global portfolios that are globally diversified across multiple asset classes. And in a nutshell, maybe I'll preface that is that I've watched the portfolios, shift from a very heavy US equity bias, right, to very much more of what I would call a neutral stance, but higher Canadian equity content, certainly higher international content, higher safe instruments like bonds, which makes sense because interest rates have been higher. But that shift from the US to Canada, quite frankly, is something I haven't seen for about 15 to 16 years, if not more.
So you're exactly right. So the way we're positioned right now, we are in general actually overweight equity, underweight fixed income. So we have a slight underweight to bonds and a slight overweight to stock. But within the stock universe, we are actually underweight US, overweight Canada, international, and emerging markets. And there's a lot of factors that go into a decision like that. But basically, it comes down to we see similar growth for companies in Canada and in international areas, as well as emerging markets, as we do in the United States, but they're cheaper. They're cheaper in Canada, they're cheaper in Europe, they're cheaper in Japan, they're cheaper in China. And that's the edge that we see. And so we've seen this actually since Liberation Day, where the rest of the world, let's call it that, the rest of the world has outperformed the US, and it continues to do so. Not that there's anything wrong with US companies or the US economy, it's that they have the most expensive price. And so if you can get the same growth at a cheaper price, whether that's three-quarters of the price or two-thirds of the price or half the price, you should do that. And so that's why we've leaned into these other areas, and we've benefited. Our clients have benefited as a result of it because these other areas continue to outperform the United States. And interestingly, given what's going on with Iran right now, Canada is actually a defensive position because of our exposure to oil.
Sure.
As oil prices have moved up, the Canadian stock market has done well. The energy stocks have benefited greatly from
Yeah.
this. And so we actually have this built-in hedge that, even though we're getting a little bit of volatility in stocks in general, Canadian stocks are weathering it better than other areas. So that overweight is actually adding value.
Yeah, I think it's shocking. Most people would be surprised to note that the TSX is in positive territory year to date.
Mhm. Exactly. But that's just the makeup of our market, right? Gold is, even though it's off from its highs, it's still up year to date, right? So that's been a positive. Oil, that's been a positive. Those two sectors represent almost a third of our stock market, and that can provide a lift to the rest.
Yeah. Excellent, Philip. Well, listen, I won't keep you much longer. Again, these are just wonderful touch points. It gives us the opportunity to not only catch up and to hear your viewpoint, but also for me to bring concerns from clients and that, we get direct answers. And so we always share this. And I know that we get tremendous feedback every time. And I wanted to thank you and keep up the great work.
Well, thank you. I'm very happy to do it, and keep those questions coming.
All right. Thank you.